Are you ready to step up? The pursuit starts here. Welcome to today's episode of The Pursuit of Excellence, the show where we go beyond the surface to discover what separates the good from the truly great. We dive into mindset, disciplines, and strategies to push past plateaus, master the fundamentals, and redefine success on our terms. This is The Pursuit. Today, I am joined by Evan Gruchot, a heavy hitter in the world of finance. He's the founder and CEO of EG Capital Holdings, outsourced CIO for 7 RIAs, managing nearly $500 million, and a consultant to 5 private equity and venture capital firms with over $10 billion in assets. He also sits on 4 advisory boards, shaping the future of private equity and private credit. Evan doesn't just manage money, he sets the standard. He's built a career on bold moves, innovative strategies, and an unrelenting pursuit of excellence. But what I find even more compelling than the resume is the mindset it takes to operate at that level. Spotting opportunities others miss, staying disciplined when the stakes are high, and constantly raising the bar. That's the journey we're diving into today. Evan, welcome to the show.
Thanks for having me.
I'm excited to dive into all of the things that we are working on. So, I really like to start out with understanding what your version of excellence is. How does that show up with the diverse veins that you're working in? Everything from portfolio management to how you engage with the advisory boards. Where do you start with excellence?
Well, I would say one of my favorite quotes is from Vince Lombardi, and it's the measure of who you are is what you do with what you have. And so I think you go a little bit beyond that. And if you are blessed with a certain skill set or certain talent, it's on you to share that with the world. And so I look at excellence as wanting to constantly grow, constantly improve. I've always liked to say I like to find the most efficient way to solve a puzzle. And so I've found a way with EG Capital and with my team that we're able to really impact a lot of different people, a lot of different businesses. No two conversations are really the same, and bring that exact sort of mindset of like, how do we solve this puzzle? And every different task or challenge that we face is going to be different from the last. So it's always trying to improve, trying to grow so that we can handle each of those challenges as a team. But at the end of the day, I think we have the opportunity to really impact a lot of people. With some of the projects we're working on, I had the other day, just like I was talking with a buddy of mine out in California, and I was like, it is crazy. Like I'm helping like Medicare save a bunch of money with some organ transportation companies, and we're helping with hydroponics. And so we're getting to touch all these different types of like really impactful projects that as a result, it actually makes me feel like we're making an impact on the world.
Yeah, I love it. I love a good save the world project. For me, legacy is something I talk a lot about because it's just so important and like a personal mission of mine to leave the world a better place than how I found it. Anything I touch, it needs to be better than how I found it. And so I think with EG Capital and the rest of the advisory boards, you work in so many different lanes and you have so much access to capital. What is it that you are looking for when you're identifying opportunities to actually invest in?
I think it's a mix of quantitative and qualitative data. Quantitative being, hey, is this a profitable company? Is this a company that actually has like positive revenue growth and trends so that this is a viable investment, obviously. But then the second piece being the qualitative is do we trust the owner? Do we believe in the actual idea? Like you could have the best profit, the best balance sheet, but if I don't think that business is going to be around in 3 years, we're not going to help.
Yeah.
Because at the end of the day, I have to be bought in as well as if this is my own money, because in a lot of cases, it is my own money going in addition to what we're helping raise and what we're helping capitalize. We take equity in pretty much every deal that we do help fund or finance. And so as a result, we have to really be bought in on the mission of the company, the vision of the founder, the principles of the team and the culture. that that company has, as well as the product and what it actually, whether it's a service or an actual physical product, whether it has, my mom likes to use the tone, like it's got good bones.
I love that.
And so it's a mix of the very basic, like modeling out financially of, hey, is this something where we can get the type of return we're looking for? Is it going to have the liquidity event at the time we think it will? But I put a big premium on the qualitative side of things of, do I believe in the founder first and foremost, because the numbers could be great. But if I've learned many times that it can be the people that actually set us up, like that really deter the business from growing.
Yeah. No, I was just talking about, culture and truly having leadership, backing the right jockey, and really understanding what it takes to grow and scale. Because if they are getting funding, what is it that they're eventually going to exit? Because they want an exit strategy, but the company itself, the people of that company aren't exiting. So it's how do we make sure it's going to have sustainable, profitable growth? No, it's really cool watching, just me personally, because I get to sit in on a lot of the deal structuring conversations, is listening to you work through how to potentially structure the deals. And so what I've really enjoyed, like how you approach it, is also understanding what's best for the company, the taxes. A lot of our core values are around innovation, efficiency, integrity, the business owner mindset, and really understanding how to drive for the future and that sustainable, profitable growth in order to decentralize. And so I would love for you to sort of talk through what it is that you're looking at from a structure standpoint, because a lot of people who are watching this are business owners. They are, engaged with other business owners that are looking to grow and scale. So what is it that is available to them rather than just going to the bank to get a loan?
Yeah, I think it depends on the company itself. A lot of cases, as you've heard me talk when we're with somebody, a business owner that is actually looking for sourcing of funding, and we're introducing them to a private equity or venture capital partner. But it really comes down to what is the right structure so that you don't end up super cash flow negative. Because if you take on a bunch of debt at really high interest rates, you might not, you hit one bad month and all of a sudden now you're potentially getting called on your loan. And at the same time, on the other side of the coin, you don't want to just give up equity, because this is something that is going to grow and you have enough like revenue metrics or LOIs in place from big orders that haven't come through until you're able to get a certain product or manufacturing facility or lab built. You want to make sure you're not sacrificing on the long-term side of things either. So sometimes it's finding the right mix between debt funding and equity funding. And on other times where, hey, a bank might go and say, yeah, we're going to give you $250,000, but you need $5 million. And so as a result, finding the right mix between all of them can be very crucial to not only making sure your business survives, but also scales and grows to the exit you want. And so sometimes when we're structuring things, we're also making sure that the marketplace itself has attraction to that too. Because if you have a business that right now is probably really struggling, there might not be as much appetite to give you debt. If you have past bankruptcies or past lawsuits, there might be someone that's going to say, hey, we're going to give you debt, but it's going to be at 30% plus rates.
Yep.
And it really comes down to, at that case, maybe we do take on some equity there, but we put in call or put provisions inside of that equity so that you're not handcuffed for the super long term, where we can go in and say, hey, this makes a lot of tax sense for the investor because they have the right to get out at any point in time with a put, but you also have a call on your side where you can say, hey, I'm going to give you a minimum return here, and you're going to have really helped the business grow. But in a lot of those cases, I find when that happens, they really appreciate that equity partner, because if we find the right equity partner, they're also helping drive business. In addition, they're also helping with some guidance in some cases. And so that owner that took on that equity partner, in a lot of cases, doesn't want to give up doesn't want to actually execute the call provision because they say, hey, this person has really helped grow it too.
Yeah. I mean, it's been incredible to watch, especially being so protective also of the vision of the owner of the business. So definitely a privilege in that capacity. As far as the outsourced chief investment officer vein that we operate in, I'd love for you to give perspective of what that actually is, how we manage portfolios, what it is the investment philosophy is around portfolio management.
Yeah. So the core of EG Capital started as the OCIO side of the business and the launch of the hedge fund that'll launch later this year. But it really came down to, I had a great network of all of these advisors that were like, hey, we love what you do. And it got to the point where I said, hey, I should control the licensing rather than working for a bigger firm where they're bringing on new advisors and it's adding more work to myself and my team's plate. And they're saying, hey, we really like what we're doing on the investment philosophy. At its core, I said, hey, I am client facing. I'll handle reviews for you because I was an advisor myself. I can go as high level as like making a comparison to a organ getting cells to compare to dividends for somebody that's like a biology background into the super technical
your
details.
salsa analogies.
Yeah, my the
your HEB
the taco, the tacos, the taco analogy. But at its core, we're basically taking the research and all of the connections that we have inside of the financial services industry that I built through my career, and applying our own research to it and really giving access to advisors, my brainchild at its core, but also really solid execution. We've got our portfolio manager who's out in California, so it's nice that we've got that time difference, so I can kind of start the morning and then hand things off to him. But we're really taking kind of a private equity type approach to the financial advisory and RIA space, where we're saying, hey, you don't have to sell us your business, because most advisors right now are in their late 50s and they are either at a point where, hey, I want to sell, but I'm not ready to retire just yet. I really enjoy getting to talk with the clients that I've built relationships with, and at this point are friends over the last like 15, 20 years. I like going golfing. I like going to the meal, like taking people out for meals or going to different events or just going on vacation with my family. But I'm kind of tired of the day-to-day of like what's going on in the market, having to make the trades, things like that. So we help bridge that gap between, hey, let's get you to the point where you want to sell. Let's also come in and actually make sure you've got the systems and scale in place so that you're really attractive to a buyer. Then that also gives us first right of refusal when it actually does come time of saying, hey, I want to sell. Or a lot of these are now family businesses where it's a advisor that wants to hand it over to their children, but the child might have just graduated from college and it's like, I'm not about to hand over the keys to the Ferrari right away. And so we're able to come in and work for the next 5 years, get them to where they can go on vacation and not have to worry about what's going on in the business, because our most premium offering is a fully outsourced investment department where we take care of your paperwork, we have your software, your compliance, in addition to your investment models, your trading, your billing, handling your payroll for if you have multiple advisors on staff. And so we're really able to help fit that niche of those advisors that maybe aren't SEC registered yet and are state registered, so less than 100 million of assets, and at a fraction of the cost of hiring our team if you wanted somebody just there in office every day, but still getting that same feel as if you're not having the drop-in service.
Yeah, I think for me as an advisor, serving as an advisor for the last 9, almost 10 years, which is wild. I can't believe it's been a decade. I think the biggest challenge for me was really understanding who is designing the portfolios, what money manager we're trying to select, what is it, the risk tolerance, the time horizon, all of the paperwork for the annual reviews, literally just making sure that we are buttoned up, efficient, effective with every single client and consistent across the board, and just having confidence in the team that was behind me. And so being able to competitively differentiate in this space where the portfolios that you have designed have tremendous performance capacity, as well as significant downside protection across the board, and it is actively managed. So for people that are, just familiar with Edward Jones or just familiar with an ETF or a mutual fund who, they are building their nest egg, but they're not comfortable yet really understanding what an active managed portfolio looks like, feels like. What is it that your investment philosophy is around how you create the portfolios, but then also translated it to them?
You've been in conversations during this, and I say this many a time when I'm talking to somebody that's a little bit younger. I say, you're not going to need me right now, honestly. You're from an accumulation standpoint, you can throw a couple darts at the board and you're probably going to end up just fine. Obviously there's a big push right now to just passively owning the S&P 500, and that's going to work for probably 99% of people, in all fairness. But where I've spent a lot of my time in my designation and there's been many studies, you look at the lost decade from 2000 to 2010, is when you actually want to start taking that money out, making sure you don't run out of money. And that's where active management can have a major impact. Yeah. Because if you have a case like just 2022, 2 years ago, both the stock market and the bond market were down double digits. Bond market finished down 13%, S&P finished down 18%. And so if you were just in that passive and you were retired and you started taking out money, at that point, you're probably dipping into principal. And so making sure that if you do have some active management, just to pick on 2022 in particular, like what we were doing in bonds, as I mentioned, the bond index was down 13%. We were up 2% in bonds. And so that's a 15% outperformance right there. And so that's, hey, we can still draw from this bucket and we're not actually dipping into our nest egg necessarily. And then we look at alternative investments. And that's an area that, especially on the OCIO front, that we really bring to the table because A, we're sometimes creating those deals, but B, we have all of this exclusive access from the other funds that I consult for or advise on, that we get really cool deals because everybody can go out and get the JP Morgan like mutual private equity fund or private credit fund and Goldman Sachs funds and everything like that, as long as they are an RIA, or honestly, if you're at a big broker dealer and your advisor is at a Raymond James, Edward Jones, Mass Mutual, Northwestern Mutual, LPL, they all have access. Don't let them tell you that they have anything exclusive, because honestly, if you are an accredited investor, you can go direct too. But where an advisor comes into play, and especially with the OCIO front, is we sometimes will have products like, for us particular, we're creating products in a lot of cases. And so you can't get access other ways.
What do we have right now that's super exciting that would be competitively differentiated?
Nothing that's not under an NDA right now.
Got it. Can you give me so that they have context for it? So what is it that we're structuring as an alternative? Because again, I come from a big broker dealer where alternatives were not something that we ever really truly had access to. I never had an education to. So when I did finally go independent in RIA space and have access to alternatives, my mind was literally blown. So as an investor, as an advisor, what is it that I should be asking questions around when alternatives are on the table?
I would say private credit right now. The thing I talk about with alternatives as a whole is, so publicly traded companies, there's only about 3,000 right now. So you're going to have not a lot of discrepancy between the top investment manager and the worst. Especially in the large cap space, there's not a huge discrepancy between what the returns will be. But because there are so many alternative investments, think about the Instagram ads or LinkedIn ads that you get nowadays of oh, this real estate fund, this oil and gas venture, this hedge fund, this option strategy, this Forex strategy. There's just so much of it that it really comes down to, if you're the client, having the time to really research, do the due diligence. Do you have the expertise or the background to even kind of know what's going on with those deals. And so like some of the private credit stuff we're structuring right now is individual like purchase order financing or factoring, or merchant financing it's also called, where we've done a lot of the due diligence of finding the right company that has the right balance sheets, that has good creditors in terms of the people that are buying from them. And then we build within their profit margins to where we're able to help them grow as a business and they're comfortable with it, but also get our clients a really great return.
Yeah.
We've got one that's 12% right now on for the life of the loan.
I think the thing that truly blows people's mind when I start talking about private credit is the downside protection. So at least the risk mitigation strategies associated with it. So when he's talking about doing the due diligence, it's making sure that the terms of that opportunity are really protective of the investor, but also of the company, right? So we want to make sure it's a win-win across the board.
Yeah.
But the risk mitigation side of it is also in place.
And liquidity is huge too.
Mm-hmm.
I was evaluating a deal that was really solid on paper. It was a 3-year fixed rate, 25%. And then I got into the documents and it said, hey, at the end of the 3 years, it actually converts to equity, which is
not what you
sounds great on paper, but it's where's my liquidity?
Yeah.
So it's not actually a 3-year note. It's a 3-year automatically converted note. And so you're really not even realizing that 25% because it's not paid back to you. It converts into equity. And then that equity, you're entirely reliant on an liquidation event. And so it could be another 7, 10 plus year hold.
Yeah.
And what sounded great on paper of like, hey, I can put $10,000 in and I will make 25% every year for the next 3 years, guaranteed. Which anyone listening, I did put quotation marks there because I realized this is cameras.
This is disclosure.
But that's not really in that case. And so we do factor in like liquidity. We want to make sure that if you are structuring a private credit, that it's collateralized too. Mm-hmm. Like don't make yourself a credit card company where, hey, all of a sudden this person just defaults and you're out all the money. Make sure that there's assets backing it so that like worst case scenario, because it can happen, that you're actually going to get your money back in one way or another, even if it does take longer through a bankruptcy proceeding or anything like that. Now we try to find deals where that doesn't happen, but nobody's perfect.
Yep.
On the private equity side, you're also looking for companies that have a potential liquidation event coming up, an IPO, a merger, a private sale, or just doing so well that they're going to pay out a dividend so that you're actually getting cash for your investment. Because if that's the case, then you can always make yourself a secondary market. If your neighbor's like, hey, I really like that, and you're like, well, I'll sell you some of my stake, you just broker a private transaction between the two of you.
I love it.
I
love it. So for people that aren't familiar with what a secondary market is, you want to...
Yeah. So secondary market is, think about it like the garage sale. So you have all of these things that you own and you post a sign in your yard and you say, hey, I'm having a garage sale. And then you put each of the items on the table and then people come up and they're like, hey, I know you want $5 for it, but will you take 3? And then it comes to you to say, yep, I will take 3. Or you know what? Actually, now I just got another call. Someone's offering me 7. And so it's very much like the garage sale where it's whatever someone will buy it for you. It's anything you own assets wise is only worth what people will pay you for it. And so a secondaries market is really just a private transaction that takes place between 2 accredited or qualified investors.
Amazing. I'd also love for you to do that analogy thing that you do to talk about like the bond portfolios and whatnot, or our leveraged equity, or like the mindset around how you've constructed the different portfolios.
Yeah. So I always like to talk about like active versus passive. I think that's what you're getting at, and you want the taco analogy.
Yeah, I would love the taco analogy.
So we're here in Florida, so I'll use Publix. Okay. And this actually started when I was talking about like an independent broker dealer versus like a wirehouse. But it applies the same for like ETF construction. So oftentimes we see a lot of portfolios where it's all Vanguard funds or all First Trust or all Fidelity or all Schwab. And I like to compare it to you're making tacos at night. And you go to Publix, you can buy the Publix brand salsa, the Publix brand tortillas, the Publix brand ground beef. And for most people, it's going to be a great taco dish. But what if you can get the paste salsa? What if you can get the Wagyu beef? What if you can get the Totino's queso? And I always ask, which taco dish are you going to like better? Now, when I say active versus passive, is Publix brand might be the best in some options. So I always like to compare like mid-cap index because no active manager in ETFs, mutual funds has ever on a long-standing basis outperformed the mid-cap index. So it makes sense to be passive. Buy the Publix brand there. But if we look at stuff like large cap, there are funds that have outperformed the large cap. The Magellan Fund with Peter Lynch has some of the best track record ever. It's not available in what it was now, but now they have an ETF version of it. They have a mutual fund version of it. And so active management can win out too. It really just comes down to what you're cooking for dinner that night.
I love it. Yes. Making me hungry. It's almost lunchtime. I love it. Okay, so shifting gears a little bit. So, I want to continue to come back to the ethos of the show, which is the pursuit of excellence, right? So we're always growing and scaling. We're always being innovative. We worked through a lot of what we wanted to achieve as a whole with EG Capital. What do you see the evolution of EG Capital in the next 5 years?
Yeah.
Or what is the next level of excellence?
Yeah, I would say the next level, we've talked about kind of the mission of the company is to help lower the barrier of entry to a lot of these alternatives, a lot of these private markets, to where I'm just looking kind of as the industry as a whole goes. You have a lot of advisors right now that really aren't needed, honestly. And so it's a case of the private equity funds are going direct to customers and clients now. Hedge funds are becoming more and more available. One of our holdings is the hedge fund still exists, but he closed it down and now he launched an ETF and it's been phenomenal. And so I think eventually bringing out our strategies to ETFs, so that it's more tax efficient with in-kind money transfers as opposed to selling and passing on capital gains distributions. But really to where somebody on their Robinhood account or Webull or I forget all the free trade ones or Schwab, Fidelity, can go in and just buy it themselves and never even have to have a conversation with us and just get access to some really great strategies and products, and to the same where advisors can do it as well. And eventually I see the industry moving to where, with all these robo-advisors, things like that, I see it to where there's going to be a vehicle available for people to get access to private equity, private credit at much lower minimums. That's the whole idea behind the hedge fund. I've found some great institutional partners where if you wanted to build that same portfolio yourself, is going to cost you $15 million plus. But we can give you that same exact model and performance for $500,000. Which is a heavy discount. And eventually, as that fund grows and grows and grows, we're going to be able to lower our minimum, launch it as maybe an interval fund structure, to where people can buy it themselves at $2,500 as it continues to grow and become more open-ended. We just got to get to that point.
It's so exciting. So, as we go through getting into Q4, a lot of business owners are watching. So, and a lot of exits are happening right now. So I'd love to get your perspective around what are best practices, what do people need to be cognizant of from a tax strategy standpoint. Truly best practices going into Q4 and year end. on how to make sure that operationally they are prepared to manage what that exit looks like, what their tax burden looks like. I know we have access to several different strategies that enable them to be proactive around it.
Mm-hmm.
So talk to me about taxes.
I am not a CPA.
Perfect.
Let me preface with that. I'm not a CPA. I have no real tax background at all. But as you and I have talked about, there is depreciation that you can take with the Big Beautiful Bill that launched. You've got the ability to do cost segregation studies in real estate and get advanced depreciation there. You have your classic Section 179 for those that are going out and buying an Escalade or a G-Wagon. But there is, I would say, if you're looking at going into Q4 and before year end, now is a really great time to actually act on these, because if January 1st rolls around and you're sitting on a bunch of cash, guess what? It's going to the IRS. And so finding investment opportunities that might have tax benefits, like real estate or oil and gas, or just spending it on assets within your business. If you need a bunch of equipment, if you need a new facility, if you need office furniture, office supplies, in theory, you've had the first 3 quarters, and I know some businesses are very cyclical where the holidays tend to drive a ton of revenue. Once you do have all that cash, don't just sit on it.
Yeah.
Make it go to work for you, because once it's working for you, you are helping your business continue to grow. Yeah. But B, if you spend it and you spend it the right way, you're helping offset some of your tax bill. But don't just spend it to spend it. Yeah. Don't just be like, hey, I'm going to go take my team out for a really nice dinner or lunch every week for the last week of the year because I got to spend this money. That's spending $1 to save 37 cents.
Yes.
But hey, let's go buy new office furniture, or let's buy office chairs and have the invoice come in and pay the invoice. That's a little bit of a different story.
Yeah. So a lot of times what I'm coming across is people. So before we talk more taxes, just to be very clear, we are not CPAs. We are not giving tax advice. We are looking at strategies to help support your existing team that's doing the tax filing. Right. So when we're coming in from a wealth management standpoint, we want to create efficiencies across the board. So we want to look at everything in your ecosystem to figure out, how do we maximize what it is that you're spending money on now? Is there opportunities to take depreciation if you've bought commercial buildings, if you're doing short-term rentals? Can we utilize cost segregation to take active depreciation in that capacity and accelerate it? Can we utilize investments into like the private credit space, or taking that mindset around the inventory factoring side and create leveraged depreciation so that we're optimizing that cash flow so that we can redeploy those funds into other projects to help you continue to grow and scale, right? We're looking at all of these different opportunities. On top of that, what I love about what you do is you're also looking at the investments side of things, right? Losses being carried forward, tax loss harvesting. What is it that we're doing from a strategic standpoint that may be overlooked?
I would say there's
so much. I know. Go wherever you want to go.
A lot with that. Well, I would say, like, when you're acquiring something, you mentioned like advanced depreciation or accelerated depreciation with real estate. So like one of the deals we've structured were, the issue you run with like real estate is you do have depreciation recapture too. Eventually when you sell it, you now have a big capital gain. And so you end up owing, you're not really deferring the taxes entirely. You're not removing the taxes entirely. You're just deferring them down the road. And so two of the deals we've structured kind of right now, we're able to get the invoices of all the products below the de minimis exemption, so we don't have depreciation recapture there. So we are fully removing the tax bill there, which is really cool.
So cool.
And you're still able to apply some leverage in some cases as well. And so that way, in that year, because we are making sure that we're buying assets that are positively cash flowing to offset the debt expense. Because anytime we do take on leverage, you do have a personal guarantee, because you do need to make sure that there's cash to pay for the asset, because you're borrowing money in theory to buy the full value.
Yeah.
So if you're putting down $20 and you get $100 depreciation, you got to make sure that there's cash flow to pay for that $80. But then when we look at like acquisitions, so you mentioned exit, but like if we're talking the other side and you're like, hey, I've got this cash, I've got an opportunity to buy another business. Mm-hmm. Making sure that that sale is structured the right way. So one of the funds I'm consulting for right now, we're buying a business. They've got some equipment that is financed and everything like that. Oof. And so what we're doing for the acquisition of the business is we're actually buying the equipment and doing a lease back in exchange for equity. And as a result, we're going to take the depreciation on the equipment itself, so that our investment that year, we're able to offset a lot of that cost immediately in the business. And then we're going to get our cash flow immediately boosted by wiping out that debt.
Yeah. I love it when we start getting in the weeds around an LOI and looking at how the deal is being structured for either an asset or a stock purchase in order to be able to take advantage of those depreciation, concepts. Very cool. I've never asked you this before, but you've created such a unique niche. And so was there ever a moment where like you had a come to Jesus moment that really forced you to go a different direction from just being an investment advisor to managing the investment portfolios at different firms? What is it that was a catalyst for you to really branch off and create your own thing?
There was, and it was really a case of, I just kind of sat down at the beginning of like October of last year, because this is all something I've wanted to do for a while. I wanted to like offer this. I wanted to take this, and I thought I was going to be able to do it at my last firm, and realistically probably could have. But I realized I was like, I'm just building something for somebody else if I do that. So I really, at the start of this year, sat down, and EG Capital had already been around since April of last year. But was really focused only with working with the one company. And it really came down to, I was at a due diligence event in Park City, Utah, and I was talking to another advisor about what I do, and they're like, well, I'd pay you to do that. And that was the first light bulb of like, hey, there's actually some like,
there's a market
like,
for it,
like there's a market for this. There's interest. And I was like, yeah, I would take that offer in a heartbeat. Yeah. Like that's making more than what I'm currently doing. And so it was really just a case of like, hey, if you're going to take the risk, take it now before you have kids, before life gets in the way. And I remember I was talking with one of the firms we consult for, and they were talking about one of their senior partners, and they were like, he's on the road 180 days out of the year. And I was like, oh, I don't know if I could ever do that. And then I think about literally next week I'm in Detroit, then I'm in Chicago, then I'm in Utah, then I'm back in Chicago, and then I'm in California, and then I'm finally back home.
It's the life of a road warrior.
Yeah, but I am getting a little burnt out on the travel, but if I was going to take the risk and I was going to go take the leap, it made sense to do it now. And I was inspired by watching a lot of business owners and frankly, some of my RIA clients that I've gotten to meet and know through the years, and watching them build their businesses and everything like that. And at its core, I was able to reflect on, I was like, hey, I've helped some RIAs really grow and build, and why am I not doing it for myself?
Yeah, you're extremely competitively differentiated in so many different aspects. And so it's just being an asset across the board. I always come back to something. So when I got divorced, one of my epiphanies was I can't live somebody else's vision. I can't build somebody else's vision. It's like my life needs to be aligned with my purpose and the talent that I bring to the table. And so I think what I'm very excited about building EG Capital about is like, We are so heart-centered around doing right by people and being exceptional at what we do. So whether that's identifying opportunities to invest in, managing your portfolio, figuring out how to be strategic across the board for your entire ecosystem, it's really just a privilege to be able to bring something different to the table, both from a client-facing standpoint, the end user, and the advisor standpoint, because we're driving value across the board. And so it's very exciting for me to support the overall growth of EG, because we're doing so much valuable work across the table for everybody.
Yeah. And I mean, I'm very big about putting people in the right position to succeed. And so, like, having worked with you before this, I was able to say, like, and I'll tell clients this too, where it's, hey, I'm not the guy that can walk into the room at the event and everyone's eyes turn to me, and I feel a little uncomfortable just butting into a conversation, anything like that. And not that there's anything wrong with that, but like, you are that person that, like,
I'll say hi to anybody.
Yeah, you'll say hi to anybody. But I am the guy that when you get us in a close-knit dinner table, everyone's paying attention.
We know how to make a taco.
Saying.
Okay.
And so I think it works really well. I think it's the role that I've put you in is a spot where you're really able to succeed, because you are great at meeting people, great at getting people in the door, and then like helping hold their hand as we just walk them through like our different strategic partners and everything. So that they are able to get the most value.
I like to say that my skill set is opportunity identification and then translating complexity, because it's like trying to make sure that people understand what you have said is a job in and of itself. That's why I like a good taco analogy. So, moving forward, what is it that you want to leave the audience with, whether it's insight around, the market, or being strategic going into year end, or, just overall advice to be more profitable, more, cognizant around money moves? What would you like to leave the audience with?
I've always said, I'm very big on education first. So I always like to say that when I talk with somebody, I want to make sure you understand not just the what we're doing, but the why and the how. And so, because I feel like if you do educate yourself, you're able to have better conversations around it, but B, and most importantly, be more comfortable with what's going on.
Yeah. Because
if you're somebody that's like, hey, I'm just buying Palantir stock right now, which is down 20% in the last 5 days, is you have the highs and the lows, but make sure you're not just following trends. Educate yourself around what you're doing, first and foremost. Or if you are working with a advisor or your dad or your trusted mentor, make sure that you're not just blindly following what they say.
Yeah.
Because you want to make sure that eventually, if they're not there or you decide something goes sour in the relationship, which hopefully that doesn't happen with family.
Yeah.
But we've seen it happen with mentors. We've seen it happen with advisors and things like that. You want to make sure you still kind of knew what was going on with your stuff. Great example is I had a family friend, and when I first met with him, he was retired at like 45. But he was like, hey, I realized after one of my like friends got unfortunately in a car accident and passed away, he was like, I realized that my wife has no idea, like, because he was in finance and everything. He's like, I've done very well, but I realize my wife has no idea what's going on either. So making sure everyone's educated, I will always preach that of, hey, understand what it is you're investing in, why you're investing in it. And if you're working with somebody, make sure they are able to not only know it, but teach you it too. Don't just blindly trust. Don't just blindly follow.
Yeah. I echo that.
It should be a longer sales process if you're trusting someone to manage your money.
Yes. 100%. Thank you for being here.
Thanks for having me.
Love it. Thank you so much for tuning in. This is The Pursuit of Excellence. If you liked the episode, make sure to leave a rating and review and subscribe so you never miss a show. Follow us on Instagram at the Pursuit of Excellence Pod to stay up to date on all podcast-related news. And you can follow me, Tinja Anderson, for all things finance, fitness, and food. See you next time.